Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's going on in investment markets and what to look out for in the days and weeks ahead. Now, last week's show I talked about the tech wreck that had been unfolding and raised the question whether it would carry on. Now, just to recap where we were last week, the dollar index, which is an index I've been keeping an eye on in these videos over recent months, had been pushing higher. In fact, it rallied about 2% since the start of September, which doesn't sound like much, but it was enough to start to cause some wobbles within equity markets. And all those momentum trades that had been doing very well started to unwind. And that included tech stocks, that included commodities such as gold and some of the emerging market assets out there. Now, where we are this week is there's been an attempt of almost stabilisation in markets. So last week, the VIX spiked above 31, and whenever the VIX gets above 31, that is normally bad news for equity markets in the US in particular, but that by osmosis is bad news for the rest of the world. So the VIX is the fear index, and if you listen to the Sunday podcast this week, you will have heard me explain all about the volatility or future volatility that can give you a hint about the storm clouds that could be gathering for markets. And it's been very good this time around once again at predicting the latest wobble in equity markets. The VIX started to pick up above its 20-day moving average, if you recall, and that did become a precursor to a much higher move which saw equity markets start to fall. Now, this week, we've seen the VIX start to pull back, and it actually fell back below its 20-day moving average again for a very brief period of time. So there was a relative calm started to descend on the wider market, if not the tech stocks that actually suffered most of the sell-off. Now, most of the tech stocks that had endured the largest amount of selling in the last couple of weeks actually rebounded last week. So you recall that I said that it was always likely that they would rebound given the strength of the selling that we'd seen for about a 3-day period. Well, it turned out we did see a rebound. So if you look at Tesla, for example, that has been the bellwether for the exuberance that's been in the tech rally in the last month or two. That stock price rallied 11% from its recent low. Yes, it's still 30-odd% below its high point that we saw at the start of September, but even so, it's still 400% up year to date. So that just shows you that the exuberance and the enthusiasm for tech stocks still remains. And in fact, if you look broadly across the NASDAQ, or you look at the individual stocks, tech stocks like Tesla, or if you start to look at things like Apple, which is one of the obviously biggest tech companies out there, their share prices and the index themselves have all bounced off their 50-day moving averages. So those 50-day moving averages, which a lot of traders keep an eye on, have held. So for now, at least, it seems like those uptrends we've seen in US stocks and particularly tech stocks are holding, but that could potentially change. Now, if you look at the S&P 500 in particular, we saw the February high be broken, but we then lost that. So we started to see the idea of a double top. Now, in the last week, what we've seen is the market start to stabilize, but largely drift. If you look at the S&P 500, it is broadly where it was last week, trying to break above 3,400. It's now back below that level, and it's struggling to find some sense of direction. If you go across to the UK, the FTSE 100, for example, it managed to push back above 6,000, but again, is starting to show elements of weakness. The UK stock market is still outperforming marginally the US stock market, but as I say, if you look broadly across all markets, it's been a fairly flat week. That includes bond markets, whether you look at the yield on the 10-year UK gilt, whether you look at the yield on the 10-year US Treasury. If you look at European stocks, they've been flat too. And probably the standout still is Germany in Europe if you're going to invest in any stock market. So the German DAX has been a leader for most of Europe this year, and that's largely because they benefit from their trade they do with China, lots of exports with the Chinese economy. So the Chinese rebound, they've been benefiting from that. So we're at a point now where the market is almost feeling like the aftermath of a storm, or potentially are we in the eye of the storm? Is there going to be another bout of equity weakness, particularly in America? Now, as I say, if you look at the VIX, it fell back towards its 20-day moving average. It started to pick up, because of what the Federal Reserve did this week, which I'll come on to a little bit later. But if you look at the VXN, which is the equivalent of the VIX, but for the NASDAQ, so for the tech-heavy NASDAQ, then what we've seen is that is still elevated. If it's below about 31, that's not too bad, but if it's around about 35 at the moment. So that still shows that the winds, if you use the analogy I've done before, almost like storm clouds gathering, if volatility picks up, implied volatility, future volatility starts to pick up, the winds pick up, it could be a precursor to a storm or a hurricane in the worst case scenarios, and that would be the equivalent to a big sell-off in equity markets. Well, the winds are still elevated in the tech stocks out there, so the NASDAQ 100 in particular. So that could be a sign that although there's been a relative calm after the storm, the winds still haven't completely dissipated and things could get a bit hairier once again. So we've got to keep an eye on that. And of course, we've got the US election coming up, so that's always going to throw a bit of volatility into equity markets and probably bond markets. Now, we've also seen a bit of rotation within equity markets. So some of those tech names, not just in the US, but also globally, we've seen people go into some of the more cyclical sectors. So that rotation keeps happening. People seem to think the US economy, for example, is going to rebound. So they'll move into more cyclical sectors like financials. But then they worry that it won't do, and then they sort of flock back to technology stocks again. So we're getting a lot of that rotation. So just because the NASDAQ's been falling, the Dow Jones Industrial Average, which has actually held up a little bit better, has been a beneficiary of some of this volatility and has actually performed a little bit better than the NASDAQ 100. So keep an eye on those rotations and whether they come back the other way again, as we've seen in the months from June onwards, really. So I mentioned the US Federal Reserve earlier on, and that was a big decision that was going to be made this week. And I deliberately delayed this week's show till after that decision was made. And of course, for us in the UK, that decision is made in the evening, so around about 7 o'clock. So 7 o'clock on Wednesday this week, the Federal Reserve announced their latest policy announcement and decision. Well, nothing changed. We weren't expecting any changes, no more QE or anything like that. But what is important is the press conference that happens afterwards, where Jerome Powell, who is the chair of the US Federal Reserve, starts to discuss the views of the US Federal Reserve and takes questions from reporters. And it was during that press conference that the tone was felt to be a bit more hawkish. So there wasn't enough noises, what they call dovish noises, so sort of the likelihood of more QE or that the Fed was going to keep basically bailing out the stock market. There wasn't enough of that for investors' liking. So today, if you look at equity markets as I make this show, we can see that a lot of markets around the world are down around about 1%. Of course, particularly US equities, where we're seeing even the tech names sell off a little bit more, but it's not a tech-centered sell-off. This is a minor one. It might actually escalate. We'll have to wait to see, but it's a general risk-off sell-off. So people are taking money out of equities across the board, and not just in the US. We've seen it in Asia as well overnight. So that's because the investors out there are starting to worry that the central banks might not have their back after all, and therefore won't keep rigging the markets effectively and pushing equity markets ever higher. So people have started to take a bit of profit and take a bit of a defensive stance. Now, if you go back to June, we saw a similar thing, in fact, after a US Federal Reserve meeting. So that caused a spike in the VIX. We saw a bit of a sell-off in equities. It caused a bit of a wobble, and then things got back to normal. Now, what Jerome Powell actually did as well was mention that they need a lot more fiscal stimulus. So they need the US government to do their side of the deal and start to create more stimulus. And of course, that's being held up in Congress at the moment, which is partly political ahead of the US election. It wouldn't necessarily be good news for the Democrats to have Donald Trump start to announce there's going to be some more fiscal stimulus out there, because he would try to use that for political gain in the election in the next couple of months. So while that's being delayed, it's caused people to think, well, maybe the US economy could slump further. And of course, we could have a second wave of the coronavirus, something we're talking about a hell of a lot in the UK. So to sum up, equity and bond markets have largely been flat this week, waiting to see or get a sense of direction. Even the pound has stabilised versus the dollar. It's actually now up towards $1.30. So it'll be interesting to see what happens in the coming days, how the market continues to react to the Fed announcement and other central bank announcements that we're due to hear in the sort of coming days and weeks ahead. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me via email, damien@moneytothemasses.com, via Twitter, money to the masses with the number 2. Obviously, you can contact us on Instagram, join our Facebook group, and don't forget to join our YouTube channel.